Hey everyone, if there's one concept in smart money trading that you absolutely need to master, it's order blocks. Order blocks are the footprint of institutional execution. They show you exactly where the big players committed capital. And once you truly understand what's behind them, you stop guessing and start reading the chart with real clarity. In this video, we're covering the institutional mechanics, why these zones actually form, how to find the block on your chart, how to read its anatomy, body, wicks, edges, and the Holy Trinity, 3 validation criteria that every real order block must pass. Then we'll cover all 6 block types, including the one that's more powerful than all others combined. A simple 3-question filter, and this is the big promise, to separate real order blocks from noise. 5 context factors that stack probability in your favor, and a complete execution blueprint to actually trade them, from theory to framework to execution. Let's get into it. So let's start with the real question. What is an order block if it's not just a candle pattern? To answer that, you need to understand a problem that every large institution faces, whether it's a central bank, a hedge fund, or a major dealer. When they need to buy or sell a large position, they can't just click a button and fill the whole thing at once. Why? Because of something called market impact. When you push a large order into the market moves against you. Your own buying pushes price up. Your own selling pushes price down. The bigger the order, the worse the fill. So what do? They split. A large parent order gets broken into dozens, sometimes hundreds of smaller child orders. These get fed into the market gradually, using algorithms, using timing, using stealth, all to minimize the signal they're sending. They execute where liquidity is deepest. They vary their methods to stay hidden. They use dealers and intermediaries to absorb the risk. And when you zoom out and look at this process on a chart, what do you see? You see a cluster of activity, a zone where price consolidated, where enough liquidity existed for someone to transact meaningfully. And then, a repricing event, a displacement. Price leaves that zone aggressively because the liquidity state changed. That zone, that cluster of activity followed by displacement, is what you're marking when you draw an order block. It's not a magic candle. It's a liquidity event. And a quick note, when evaluating order blocks, don't fixate on volume bars. Focus on the liquidity state and the order flow dynamics at that price zone. That tells you far more than any volume indicator. But here's the real question. Why does price come back to these zones? That's where most explanations completely fall apart. All right, so if an order block is a liquidity event, why does price keep coming back to it? You've probably experienced this. You mark an OB. Price drops back into the zone. You enter the trade, and sometimes it works beautifully. Price bounces right off the zone and runs. But other times, it slices right through like the zone doesn't exist. The difference between those two outcomes comes down to understanding why price returns in the first place. And there are 3 institutional reasons. Number 1, residual execution. When a large player accumulates a position, they don't always fill everything in one pass. They leave passive interest, limit orders, iceberg orders, hidden liquidity, sitting at the original accumulation area. When price comes back, those orders are still there, waiting. Number 2, transient impact. Market impact isn't permanent. Liquidity refills, spreads recover, depth comes back, and price naturally mean reverts into areas where a lot of activity happened. It's not magic, it's market mechanics. Number 3, dealer inventory. The dealers and market makers who absorb the original flow, they accumulated inventory, and they want to unwind that inventory at a better price, so they have a natural incentive to facilitate price returning to those zones. But here's the critical nuance that most traders miss. Price does not return to your order block because the chart owes you a fill. It returns when liquidity and incentives, residual orders, inventory constraints, mean reversion make that path likely. Mitigation is not a mystical requirement. It's a probability. Now you understand the why. But understanding isn't enough. You need to know how to actually find these zones on your chart. Let's get practical. How do you actually find one on your chart? Here's the process. It starts with the move, not the candle. Step 1, look for displacement, a strong, aggressive, impulsive move in one direction, not a slow drift, a reprice. That's your first signal that something institutional may have happened. Step 2, trace back to the origin of that move. Where did price launch from? Look at the base, the consolidation or pause right before the displacement began. Step 3, Find the last opposing candle before the move started. For a bullish order block, that's the last bearish candle, the last down close before the impulsive up move. For a bearish order block, it's the last bullish candle before the impulsive down move. That candle is your order block. 3 steps. Displacement, trace back, last opposing candle. Simple, clean, repeatable. But finding the candle is only the first step. The real skill is knowing how to read it, because every part of that candle tells you something different. So you found your order block. Now, how do you read it? How do you draw it correctly? The body of that candle, open to close, is your primary zone. This is where sustained two-sided trade occurred. Think of it as the working area, where enough liquidity was available for both buyers and sellers to transact. In institutional terms, the body is closer to where actual fills happened over time. The wicks tell a different story. Wicks are liquidity probes, brief excursions into thinner depth where the market tested for more liquidity and got rejected. So here's your framework for drawing. The proximal edge, the side of the block closest to current price, that's your entry zone. The distal edge, the far side, including the wick extreme, that's your risk boundary. Your stop goes beyond the distal, because if price accepts beyond it, your thesis is wrong. And there's one more line to mark, the mean threshold, the 50% level of the body. This is your discipline line. If price penetrates too deep through your zone, past the 50%, it may mean the opposing side's liquidity is stronger than you expected. Think about adverse selection. When price trades deep through your idea of value, that's often not a great fill. It's a sign you might be getting run over by better informed flow. So, respect above the mean threshold, good sign. Repeated penetration without a displacement response, early warning that the zone may be failing. You can find it and read it. But how do you know it's real, that it has genuine institutional weight? That's where the Holy Trinity comes in. 3 criteria. If all 3 are present, your order block has real institutional backing. If any of them are missing, you're trading hope, not structure. The first criterion is displacement. And yes, displacement is also how you found the block in the first place. But here, we're asking a deeper question. Was it strong enough? Not just did price move, but did it reprice? Did it leave aggressively without looking back? Why does displacement matter? Because in microstructure terms, a fast, aggressive move tells you one of 2 things. Either one side completely dominated, or there was a liquidity hole, a gap in the order book, that allowed price to travel fast with no resistance. Either way, displacement signals that the zone you're looking at was meaningful. Something happened there that changed the balance. The second criterion is imbalance, what you probably know as a fair value gap. That gap between candles isn't just an inefficiency on the chart. It's your visual proxy for thin liquidity. Price moved so fast through that area that very little two-sided trading occurred. Think of it this way. A fair value gap is a receipt. It's proof that the displacement was real and not just noise. The third criterion is a break of structure, BOS, or market structure shift. And this one matters for a reason most people don't think about. Conditional orders, stop losses, limit orders, pending orders, they cluster around obvious reference points. Prior highs, prior lows, round numbers. Research from the New York Fed confirms this. Stops cluster just beyond key levels, and when those levels break, the triggered stops intensify the move. So, a structure break isn't mystical. It's where latent conditional liquidity becomes active, confirming a regime change in order flow, displacement, imbalance, structure break. These 3 validate an order block because they map to real institutional mechanics, repricing, liquidity discontinuity, and regime shift. Remember these 3 criteria. You'll need them when we build the filter later. But first, you should know there aren't just standard order blocks. There are actually 6 different types, and one of them is more powerful than all the others combined. All right, this is where things get really interesting, because most traders only know one type of order block, the standard one. But there are actually 6, and understanding the differences gives you a massive edge. Let's start with the standard OB as a quick review. Bullish, last bearish candle before an impulsive up move. Bearish, the reverse. Mechanically, it's an absorption to repricing sequence. Passive liquidity absorbs flow, then displacement occurs when the liquidity state changes. You know this one. But here's where it gets different. The breaker block. This is, in my view, the most powerful block type. And it's often the one that catches traders on the wrong side. A breaker is a failed order block that flips its role. What was support becomes resistance. What was resistance becomes support. It happens after a structure shift, after the original OB thesis gets invalidated. Why is a breaker more powerful than a standard OB? Because it concentrates two forces at one zone. First, trapped inventory. Traders who were positioned based on the old OB, they're now offside, they're underwater, and when they exit, their exits become liquidity for the new direction. Their pain fuels your trade. Second, conditional liquidity activation. The break of the original zone triggers a cascade of stop losses, which, as we discussed, cluster just beyond key levels. Those triggered stops intensify the move and confirm the flip. A breaker is not just a level. It's a positioning reorganization point. That's why it tends to produce such clean reactions. Now, outside of the breaker, there are 4 more block types you should know about. The mitigation block forms when price fails to extend. It stalls, shifts structure, but without the dramatic sweep that defines a breaker. It's more of a rebalancing event, liquidity refilling, inventory normalizing, rather than a forceful flip. The rejection block appears as long wicks at swing extremes. Price probes into a zone, triggers some liquidity, finds strong opposing flow, and snaps back hard. You draw it from the wick extremes, not the body. And then there are 2 niche variants. The vacuum block, essentially a gap created by high volatility events, session opens, or news. It's a void of liquidity that price often returns to fill. And the propulsion block, which forms when price re-enters a prior OB, tests it, and pushes away strongly. It's confirmation, a second wave of aggressive flow after liquidity reaccumulated at the zone. 6 types. Each one tells a different story about what happened at that price zone. When you can identify which type you're looking at, your trade plan changes dramatically. And this connects directly to what I promised you at the beginning, the filter that tells you which order blocks are worth trading. We're getting there now. Let's deliver on that. Because here's what most traders don't realize. Markets migrate toward liquidity concentrations, areas where stops cluster just beyond highs, lows, round numbers. They attract price, not because of conspiracy, but because liquidity there reduces execution costs for large flows. And sometimes what looks like an order block is actually just bait, inducement designed to draw traders in before the real move. So, 3 questions. Ask these every time you identify a potential order block. Question 1. Was there real displacement? Did price reprice away from this zone aggressively, or did it just drift slowly? If the move away was slow, there's no liquidity discontinuity, and your order block is probably just range rotation. Question 2. Did the move create a measurable imbalance? Is there a fair value gap, an area of thin liquidity, left behind? If displacement happened but left no imbalance, the move might have been gradual enough that both sides participated. That weakens the zone. Question 3. Did the structure break coincide with a likely liquidity cluster? Did it take out a prior high or low? Did it cross a round number where stops were likely sitting? If your structure break happened in the middle of nowhere, no obvious liquidity source, the break may not carry institutional weight. 3 questions. If all 3 answers are yes, you likely have a real institutional footprint. Trade it with confidence. If any of them are no, what you're calling an order block may just be a convenient rectangle drawn around noise. Now you have the filter. But knowing if an order block is real is only part of the equation. You also need the right context, and that's what separates good setups from great ones. You've found a valid order block. It passed the 3-question filter. Before you execute, check the context, because even a structurally valid OB can fail if the conditions are wrong. First, premium and discount. Take your dealing range and split it at the 50% level. Above is premium. Below is discount. Buy bullish OBs in discount. Sell bearish OBs in premium. This gives you a natural R to R advantage. Tighter stops, farther targets. You're working with the structure, not against it. Second, the liquidity path. A quality OB sits along a liquidity to liquidity path. Price doesn't move randomly. It moves from one pool of resting orders to another. If your OB sits between a swept low and an untouched high, it has context. If it's isolated with no obvious liquidity target on either side, it's probably not institutional. Third, freshness. An untouched first touch OB is significantly stronger than one that's already been revisited. Each time price returns to a zone, it consumes resting liquidity. First touch gives you the highest probability of a clean reaction. Fourth, session timing. OB activation depends on when liquidity shows up. London, New York, the overlap between them. That's when institutional flow is heaviest. Off-hours OBS have significantly lower probability of clean displacement and mitigation dynamics. And fifth, multi-time frame alignment. When a daily or 4-hour OB aligns with a lower time frame block at the same price zone, probability stacks. Multiple perspectives of institutional interest confirming the same area. That's when order blocks produce their cleanest reactions. 5 context factors. When multiple align with a valid OB, that's a high conviction setup. So, let's wrap up what we've covered. You now understand that an order block isn't just a candle pattern. It's a proxy for real institutional execution. You know the 6 types and how they differ. You have the 3-question filter to separate real zones from noise. And you understand the context factors that stack probability in your favor. A couple of things to keep in mind as you start applying this. First, don't rush to mark every consolidation candle as an order block. Let the filter do its job. Second, context matters more than the block itself. A perfect-looking OB in the wrong context will still fail. And third, always respect freshness. First touch zones give you the cleanest reactions. Now, this video covered the foundation. In the next video, I'll cover order block trading ideas, the highest probability setups, how to actually execute them, and real chart breakdowns. So if you want to continue this journey, subscribe and hit the bell. And if you found this helpful, save the video. It's the kind of content you'll want to come back to after a few trading sessions when things start clicking differently. Thanks for watching. Trade well, and I'll see you in the next one.